Welcome to The Alternative Investor. The recent looting and destruction of malls, retail stores and several distribution centres left billions of property damage in its wake. But the question is, what is the investor sentiment towards shopping centres as an asset class following the events? And for more, we're joined by Nesi Chetty, who is a senior fund manager for listed property at Stanlib. Nesi, thank you so much for your time. I suppose that is the question we can start off with. What is the investor sentiment towards retail brick and mortar?
Yeah, good afternoon to you and your viewers. I guess if you look at the property market prior to lockdown restrictions and the start of COVID, you had a fairly healthy appetite for, let's call it, listed assets and also direct property retail assets. South Africa at the time of probably March 2020 had a very weak outlook for GDP. At a level of just under 2.5%. For the property market, I think you need that level of GDP to stimulate rentals and particularly vacancies. When we entered lockdown, and if I look at traditional bricks and mortars, given the restrictions we've had, or the severe restrictions we've had in terms of limited trading hours, impacting restaurants, the alcohol ban, it certainly had a detrimental impact on the trading densities of some of the shopping centres. I think if you look at our market, we need to distinguish between the low-end CBD community-type township centres, which even through the crisis were trading quite well because there's a bigger food component, whereas the super-regional centres and the larger big boxes, which are 90,000 square metres, was certainly impacted in terms of reduced footfall into those centres. I think the sentiment is starting even before the looting and unrest we saw last week was starting to turn positive again. Certainly, if we look at things like retail sales, we saw big jumps in apparel, food and durables, and certainly those segments were starting to pick up again in terms of the recovery. I think also what's apparent is that the traditional model has shifted in that you've had during COVID and also during the last 8 months an increase in online, which has maybe also assisted those retailers that were in traditional brick and mortars like a ShopRite and Pick and Pay to capitalize on the online offering as well.
Right. I'm curious to know what businesses did or companies did to manage that pandemic and the various lockdowns and etc.
Yeah. So I guess in the retail sector, the companies went on quite early to look at tenant relief for the tenants that were impacted, and I guess the non-essential were impacted the most, given that essential are allowed to trade. If I look at the level of rental relief in the sector, last year it was a staggering 3 billion, and that's in the form of discounts and deferments for the sector. It was different, I guess, for the various subsectors. And retail, while it was discounts and deferments, the property companies were all working with the tenant base to ensure some level of sustainability when things did open up again. Very different, I guess, in the office sector, which even prior to COVID entered from a position of weakness because of the oversupply in the market. If you look at those P and A grade office funds, while vacancies were picking up and you had a lot of tenants, a lot of individuals working from home, it did put a pressure on the top line and the rental base. What the property companies have done have used last year to look at those assets and impair them appropriately in the market.
Yeah.
And typically in retail, you would have seen impairments of 10 to 15%. Offices, you would have seen impairments closer to 7 or 8%. A lot of them did that to bring the asset valuations in line with the reduced income and particularly the reduced rental outlook in the market.
Right. Which do you anticipate to perform better? Would it be the rural community township centres or the larger regional centres?
I think if you look at that market, it's very different in terms of what the demand drivers are for CBD rural retail versus community shopping centres. If you look at a typical CBD type center, it's anchored by large dominant food retailers. And even through COVID, you've seen that they've been very defensive in that trading densities have held up. That consumer typically takes either a taxi to work and is a repeat customer. So they've benefited from that. Also, I think what's driving that market is social security funds. That's been a big drive for discretionary spend into the market, together with unsecured credit. You also have employment picking up slightly in parts of those markets. I think the attraction for the community and township-based centers is that, given that some of them are close proximity to transport hubs, the footfall is quite sustainable longer term. If you look at the bigger boxes and particularly the super regionals, a lot of them were in apparel. They were in high-end, consumer goods. Restaurants, the bigger component, and they struggled initially in terms of trading densities. You're seeing now maybe luxury goods pick up and technology because people are working from home. I would think in our fund and typically in our outlook, while we like both, we would probably favor the township and CBD centers. I think even with looting and unrest that we've seen last week, the demand hasn't gone away for those centers, and we expect that to continue.
All right, before I let you go, one thing, I'm sure there are many, but the one thing that comes to mind that you would want potential investors to know when looking at REITs?
Yeah, I think investors need to understand the risk profile of the REITs in the South African market. I think you've seen a lot of volatility in the last couple of years in the listed sector. REITs still have a volatility that's in between bonds and equity. If you invested in the South African market within the REIT sector, one of the attractiveness is the sustainable yield through the cycle. I think investors are attracted to that. Given that there's a favorable tax adjustment for REITs that pay out all their earnings as distribution, there is a level of tax savings that an investor can accumulate over time. I think what's also key is you have to take this asset class in terms of the long-term duration of the asset class, and typically in your investment horizon, it is a 5 or 10-year investment horizon. I would think investors that want to invest in the REIT and like the structure and the model should try and do it through an established unit trust. Stanlib Property Income Fund is a fund that's been managed for the last 15 or 16 years in the market. And we're expecting a return of closer to 15 or 16% on a 4-year view through the cycle. And I think now's the right time, given the sufficient discount to the asset values that you're seeing in the market.
All right, Nesi, thank you so much for your time. That is Nesi Chetty, who is a senior fund manager for listed property at Stanlib.